Right. So what I'm going to do here is a bit expand really on some of my slides from the earlier um, from part three, and just focus a bit more on the safeguards. So these are the technical bits that you need to be comfortable with now on the actual safeguards, because you see the safeguards vary depending on whether or not you're a non-listed client or a listed firm, in effect, as you can imagine. So in general, if you're thinking about this broadly, for your non-listed clients, there tends to be a sense, sort of take a sensible approach with independence. You're growing, you can still sort of, I mean, consider the fact that an accounting firm would offer a range of services, wouldn't they? So everything from accounts prep to tax computations for the company and for directors, to the audit, if you like, to some level of setting up controls, putting those in place, and even other services, even relating to due diligence or some corporate finance work. And it does make sense to have all your work done in house. So let's not throw the baby out of the yes, let's not throw the baby away. Um, so fundamentally, it's about making sure that we have the right safeguards in place. So with non-listed clients, you can see they even use the term large. So we're not quite sure. This question of, it's really a case of judgment. Because it's okay. It's not okay, but it's okay. What we need to now do is what safeguards. Okay, so try and reduce dependency on the client. So try and diversify and look for new clients. So that's what you're safe. That's what you want to be writing. That I am looking for safeguards. I'm trying to reduce dependency on the client. Consulting with the third party on key audit judgments. So having another partner within the organization carrying out an independent review of your work, if you like, and definitely having an external quality control review. And we'll discuss external quality control reviews when we look at listed clients. So this question of fees is a big issue, and you want to be able to clearly show the examiner that you understand that the fee structure, or the thinking around fees, differs between non-listed companies and what I'm going to show you next, listed companies. So with listed companies, it is very clear that we are focusing on this 15% benchmark. And so the argument really is that if a firm's independence, according to the standards or recommendations, is clearly threatened if total fees, so what I was talking about, everything ranging from tax computation, any management consulting work or audit, um, if you like, if total fees from a listed audit client exceeds 15% of the firm's total fees for 2 consecutive years. So that's the first issue there. So you must be very comfortable with this 15%. You must remember it. Um, so what you now need to do is, if you like, this really then laps onto disclosures. So you must clearly disclose this issue to those charged with governance at the client. So we discussed corporate governance, if you like, in the previous chapter, in chapter three. So the board, the chair, the risk committee, the audit committee must be fully aware, if you like, of what's going on here. The fact that we are that dependent on this client, and therefore we must put safeguards in place. So, in effect, apart from disclosures, we must also have an independent engagement quality control review. So, this is really bringing in an external party, so someone else to come in to ensure that we are performing the audit objectively, and we are not being influenced by the fact that we are very dependent on this client. So it says it here that you can either perform this as a kind of pre-issue review, so just before you issue the report, or it might be the following year. So they turn up the following year before you have a second year issue, but you've done the first year. They come back and see how you did and kept the work together, if you like, or before the third year opinion is given. So the key point here is that this is typically, and what happens is they come in and they'll take a sample of different risky audits, so kind of a listed one, a non-listed one, a high risk one, a non-high risk one. So it's really about sampling and getting, just to show that within the profession that we are aware of the need for quality control. So this question of gifts and hospitality, um, really, you can see again that what we are doing really is to make sure that we do not breed this familiarity, we do not breed a case of dependency and self-interest, that we retain our independence. So we want to be cautious about the gifts that we receive from um, our clients. So, I guess the question is, what is considered trivial and consequential? I mean, again, this we could debate this all day. Is getting a ticket to watch a football game trivial and inconsequential? Is using a director's box trivial and inconsequential? Um, Typically you'd see questions that would say, oh, if a company gives 5% a 5% discount to its employees, or a 10% discount, and they gave you guys exactly the same discount because you were up there, well, then there is no influence. In effect, it's just the same thing. But if they gave you a much larger discount, then you would argue that there's potential for being, if you like, influenced. But you can see here, it does say here that we must document this in the audit file, the fact that we were even offered. The truth is, we want to keep a distance. So again, it's a written exam, isn't it? We want to be highlighting that we want to be keeping a distance from these. We want to be keeping a distance um, from the potential of being seen to be accepting gifts. We see it in the news all the time. Even the prime minister gets it sometimes. Oh, he received a gift on a plane to go somewhere, or he got to stay at someone's home when they were abroad. All these little things. So it's more about being seen to be independent. Right, let's carry on. So typically, you and I, I'm sure, would be surprised if you would allow. Um, I mean, of course, it's possible that a member of an audit team might own shares in people own shares. That's very normal. But you would see where the conflict of interest lay if you had an audit manager who had shares in an organization, being the lead on the job. So, really, fundamentally, if any member of an audit team or their immediate family has a financial interest, first of all, typically you would have to, as part of your kind of prep work, you would have disclosed and asked anyone who had any of these relationships to declare their interest, so that we could probably safest remove them from the job. So it says here, any member of the audit team who has a close family member who owns shares should be removed from the audit team, or the family member should dispose of those shares. That's a bit strong, but this is a question of, I mean, it's an option if they're desperate to do the audit. Um, but the key point here is that we want to make sure we distance ourselves from any perception of owning shares and having financial interests and not doing anything about it. Again, you can see obviously that the partner. I didn't even talk about that, but the partner um, in the engagement shouldn't have a financial interest in the client. That would just be, impossible, outrageous, without and be difficult. I mean, again, you would have to declare it, and you would have to ask, would a third party, a rational third party, see that interest as minimal and not, um, if you like, enough to influence the user. Sorry, the our decision making. And yeah, running up to 10 minutes. Let's talk about overdue fees. So overdue fees are considered to be loans, in effect. So that's the first thing. So you want to show the examiner you understand the fact that overdue fees considered to be loans, and in effect, your stance should be first, right, that you shouldn't perform any work until there is some arrangement in place. So it's not the fact that we're not interested in the job anymore. We're not resigning. We're just saying that we won't perform any more work until the outstanding fees have paid, or there's some kind of arrangement, and we can see the arrangement working. And if that's not been paid, an independent review. So because the fear here, right, is that we'll just do the work because we want to get paid. We'll just do the work because we want to get paid, and do it, not shabbily, but just do it just to make sure we get our money. Now, again, typically here with loans and guarantees, yeah, I mean, typically there's nothing wrong if you were auditing a bank, then then this would be kind of, and you had a loan on commercial terms. That's pretty much okay. But as you can imagine, many clients are not banks. So first of all, it would make sense that a loan with a client that's not a bank is a no-no. There's just no independence. Um, so if this is the case where the assurance client is a bank, as long as it's on commercial terms and made in the normal course of business, that's fine. So loans and guarantees between audit clients and the audit team members and their immediate family that are not in the normal, well, of course, are not permitted. So it must be in the normal course of business. Um, and if the loan is made to the firm, it must be immaterial to both the firm and the client. So, I mean, whatever the issues there really are, is that any loans made. I mean, we should just not have loans made from a client to the firm under any circumstances. This is the case of it being a bank, if you like. But otherwise, we shouldn't even have loans. It's not. No. Right, great. And I think I just want to see if I can do these two in the time. No. So what I'll do is I'll pause there because I want to try and keep these in 10 minutes and then you can do them in bits and then we'll see. These are all to do with self-interest, so you can see the range of them. And so I'll carry on in part 5 in the next video.